David, it appears that those unemployment numbers out of the US on Friday have given a bit more risk appetite into the markets, and the JSE and the Rand benefiting from that.
I think all asset classes really taking some cheer from that number, Stephen. It was not spectacularly good that interest rates are threatening to go up in the US. And taking into account the weather that they had over the forecasting period, it was not a bad number at all. And the market interpreting that as interest rates neutral, therefore riskier assets positive, and we've seen the Rand benefit against that backdrop.
Of course, you said the figure better than expected. The 36,000 jobs still shed in February. When do you think we're going to reach a break-even level on the jobs front in the United States?
I think people are starting to forecast now that jobs growth will come through as early as the next figure, or perhaps the one after that. But there's a huge amount of lost ground to be made up, Stephen. So, it's really about how quickly the economic growth that has been projected can feed through into jobs growth, can feed through into consumer demand, consumer confidence, and that the recovery can become self-sustaining.
Meanwhile, the position in Greece appears to be a bit more positive this week. We had that austerity package announced last week. We had the €5 billion bond issue, which appears to be well taken up by the markets. We also have Germany and France discussing how they can help that country. So starting to stabilize in that area of the world.
Yeah, ironically, the problems don't go away. The fact that Greece managed to raise some more money on the back of some austerity measures and was well received, and the market gained some comfort. But the problem hasn't gone away. Greece and other countries around southern Europe do have huge fiscal challenges, as do some of the first world nations like the UK and the US. So, but for the medium to, or short to medium term, really, it has been taken positively by the markets, and we've seen the euro rebound from its recent lows.
Of course, we do have Portugal this week discussing its budget deficit problems. Do you think the focus might just shift to other countries in the European Union?
Stephen, it's hard to see over time, medium term, how the focus on fiscal problems is that we're not going to escape those problems. The whole globe is really faced with these challenges as government has stepped up spending to ward off further crises, and everybody is faced with huge challenges as far as budget deficits are concerned, and that's the great fear at the moment. Should we face a double-dip recession, what's left in the arsenal to fight that off? So governments and authorities around the world very, very keen to make sure that the economic growth or the resumption of growth takes hold, becomes self-sustaining, so that we are not faced with that possibility. Portugal, but another one of those countries.
Of course, we have France today vying to crack down on financial speculators, which may be partly to blame for some of that Greek debt problem. But hedge funds, interestingly, weren't allowed to participate in last week's bond issue. Do you think that we're going a step too far, that we're actually going to be taking liquidity out of the market by excluding speculators and hedge funds from the markets?
Stephen, this is the age-old question. Does the market need speculators? My answer to that is absolutely yes, it does, because they also provide the necessary inflows when they are required on positive news. But the problem is the world never learns. We never gain any perspective from our historic problems, and there's no doubt in my mind that at some time in the future, the timing is unclear, however, is that we will face similar challenges of similar sets of circumstances, because we never seem to learn. Asset bubbles come and go, but they do seem to affect the global economy to a greater extent moving forward.
Now, we had Chinese Commerce Minister Chen Diming saying this morning that China is going to reform its exchange rate policy in a gradual and controlled manner. What do you make of the statements coming out of China at this moment? Do you think we're going to lose that peg on the yuan?
I think it's a very important statement. Again, the timing is all important, because the statement appears to a normalization of the economic situation. It's not long ago, 24 months ago, that China was trying to reform its foreign exchange policy regime. The fact that they're talking about resuming that now is very good, because it may go some way to addressing the imbalances in the global system. But of course, China remains a growth engine, and they don't want to do this too quickly, and I guess the world doesn't want them to do it too quickly. Least of which is the Americans, because they own so much debt, and they fund the American deficit. So it's an important statement, but I don't think anything's going to happen dramatically too soon in any case.
David, how do you see all of this having translated through to the rand's movements today? We saw some quite firm moves this morning, around 7.38 against the dollar, and we really weren't looking at such strength this time last week.
Well, Stephen, I think the rand's move from recent highs as high as close to 7.90 has caught many by surprise. Certainly I was surprised last week by the turnaround. But I think the rand is gaining some traction, and we're now facing some very crucial technical levels at 7.34 and 7.30, and beyond that 7.20. Everything playing into emerging market hands at the moment, particularly for high yielders, because we're seeing data come out that is going to sustain the low interest rate environment around the globe. Yet the sort of risk aversion is fading away, and people are happy to put their money into riskier assets, and the rand is gaining on the back of that.
Well, we have business confidence numbers coming out from the Bureau for Economic Research tomorrow. We also have manufacturing and mining data coming out on Thursday, and the market looking for growth of about 5.6% in the manufacturing sector for January. What are you looking for here, and is this potentially rand moving?
I think so. You know, one of the concerns around the rand in the last couple of months, or in fact, the sort of last 12 to 18 months, has been our manufacturing capacity. And of course, as the global economy does recover, our exports should gain on the back of that, and we should see a resumption in manufacturing. Given the recent economic data that has come out, I don't think we're going to see a major surprise on those numbers, because everything has been pointing to fairly robust growth, resumption of growth in South Africa, and it wouldn't surprise me at all if we did see some very good numbers coming through on that front, despite the strong rand, of course.